One of the ways to profit from stocks is the buy low, sell high strategy. In case you don't know, this means buying something when the price is low and selling when the price is high. Stunning insights, Ognan. The strategy sounds simple, but it actually isn't. And now I will talk about how to do it, what it is good for, and what problems you will face by executing it. The buy low, sell high strategy relies on the price appreciation of a stock. If you buy company X for $100 and sell it for $200, you obviously made 100% profit. The tricky part is that because there is no cash flow involved, since you are not relying on dividends, there is a degree of speculation involved. You don't make any profit until you sell. You might be sitting on that stock for 5 years, and the only thing you will be seeing is your profit on a screen. But it's not real until you execute a sale. How do you know when to sell though? This is what we will discuss now. There are hundreds of ways investors use to determine when to sell a stock. Since I don't want to make this video 5 hours, I will briefly look at 4 of them. The first one is the PE ratio. PE stands for price to earnings. Earnings is basically the profit of the business. If a company earns $1 million per year and it is worth $20 million on the stock market, then it has a price to earnings ratio of 20. 20 is the multiplier on the $1 million of earnings the market has put on a stock. The more stable and with better future prospects the stock is, the higher the multiplier, also known as multiple, will be. If the price goes to 25 million while the earnings stay at 1 million, then that means the market is valuing the company and its profits at a higher level. Pretty simple. Investors like to look at what's known as the average price to earnings ratio. They take, for example, the average of the past 10 years. If it is 15 and now the stock PE ratio is 25, then the common wisdom is that the stock is undervalued and you might want to sell it. However, I personally don't like to use this indicator because it is very flawed. It tells you nothing about the future prospects of a company. It might happen that the company has revolutionized their business and the big gains are just getting started. And the problem is, you would have sold early because you were looking at the average for the past 10 years, not factoring the big changes that are happening. Another way to see if something is undervalued is the market sentiment towards it. Since this is more of an internal psychological assessment, there isn't exactly a hard piece of data that you can use. It's just the market's positioning. Some people use call or put options, which are basically bets on whether the stock will go down or not, but that's far too complicated and is for traders, so I won't get into it here. A useful tool you can use for the market in general is the Fear and Greed Index, which you can find here, but this tool is used for the market as a whole, not individual sectors or stocks. With the next 2 ways, we are getting more into the realm of trading and technical analysis, so I will just mention them quickly. The first ones are various momentum indicators. Example of that are relative strength index known as RSI and Williams %R. When you use them on a chart, both are showing you whether a certain stock is overbought or oversold. If the stock is overbought, that means that it is way above the normal and there is too much buying activity going on, which means that supposedly there should be a pullback of price and you might want to sell. On the contrary, if it is oversold, that means there are way too many sellers and the stock is out of balance, which means you might want to buy. I'm oversimplifying it and it's not as easy, but this is not a trading course. The last way I will mention are the support and resistance levels. When you are looking at a chart, sometimes you will see a lot of places where the price has bounced and gone back and then bounced and gone back. These are called support for the downside and resistance for the upside levels, and they indicate that there is a big battle between sellers and buyers there. Once the price breaks out, a lot of people use it as an indicator to either sell or buy, depending on the direction. Now, all of these methods are very problematic and to me are not suitable for the average investor. I think that the only really good way to use the buy low, sell high strategy is to have an overview and opinion of a company or a sector and understand the reasons why it might do well in the longer term. And by longer term, I mean years. For example, if you thought that social media would have been a big thing back in 2013, you would have done very well to purchase Facebook stock, which is now called Meta. Once you have that overview and conviction, you buy and you hold for 2 reasons. The first reason would be to build up your wealth and protect yourself from inflation for an indefinite future. Let's say you believe the technology sector will do great and you know you might want to start using your money for something 20 years down the road. You buy a fund full of tech stocks and you wait. 20 years have passed and now you want to start spending. Hopefully you are right and now your money has been multiplied. A second reason why I think someone should use that strategy is for tactical purposes of buying something. Let's say a house or a dream car or whatever. That way you have something to aim at. Let's say you have $50,000 and you want to pay your mortgage that is $100,000. You hope that in 4 years, those $50,000 would become $100,000. On the fourth year, hopefully you are right, the $50K have turned into $100K, you sell all of your investment and you pay off your mortgage. You had a goal, you knew when you reached that goal, and you fulfilled it. The reason why I don't think it's a good idea to hold stocks that don't pay dividends without any direct goal is that you essentially turn from an investor to a charity. I sometimes ask people, all right, so when are you planning to sell this company? They answer to me, never, it's a great company. I'm like, okay, does it pay a dividend? They tell me, no, it doesn't. And I'm thinking, wait a second. So you just gave your money to a corporation that doesn't pay you anything for owning it. And when I ask you, when will you take profits? You say never. Pardon me, but I think this is the definition of charity. You gave part of your wealth to an organization. That organization is working with the money and you will never make use of it. Having said that, it brings me to the problems with the buy low, sell high strategy. The first one is that it often turns into buy high and sell low. Very few people can accurately predict the market's movement consistently, and so if you try to do more short-term version of the strategy, by short-term I mean months, it will likely backfire. Statistics are simply not in your favor. That leads me to the next issue. As I said, no one really knows when the highs and the lows are, and so it's really hard to decide when to take your profits. How do I know? I have actually asked people. This is a poll I made in 2022 in a local investor Facebook group with tens of thousands of members. The question was, to sum up, if people who have non-dividend paying investments have sold them for a profit in late 2021 and the beginning of 2022. In the picture, you will see the word capital gains, which means the profit you make from selling something at a higher price than you bought it. So why exactly did I ask that question? The reason is that ever since the financial crisis of 2008, these types of assets described in the question were going up and up and up, and that was known as the longest uptrending or bull market in history. However, it ended in 2022 for reasons that are beyond the scope of this training. But what you need to know is that for the first time in over a decade, the prices of these assets fell with tens of percentages, in some cases even up to 90%. The idea is that if you couldn't take advantage and make substantial profits before prices crashed during more than a decade of the biggest increases in prices of assets in the history, well, then when the hell do you expect to be able to do that? The result was, as you can see from the poll, that out of 282 votes, 87% of people didn't do it. 87% following the strategy of let's just buy and hold and I will sell in the future couldn't take advantage of the best time in history to do that. Well, if they couldn't do it then, I would argue that they will never be able to do it because it's hard. Because you don't know if now is the right time. You don't know if it is a temporary crash and you don't want to feel like a fool for selling. It's hard to predict and it's really tough on you mentally. And to prove that to you, the same assets went up like crazy in 2023, just as everyone was expecting recession and new lows. Another issue is that you depend on the market's perception of a company, not only the company's real cash generation ability. We already discussed the PE ratio, where the market assigns a multiple on the profits of a stock and this creates the price. Well, if for some reason the profits of the company stay the same, but the market decides that it will value it at 10 multiple instead of a 20, the price drops in half. And this might be because of something a country leader said on the other side of the world that spooks people. At the same time, your stock might be selling the exact same amount of soap or shampoo or oil and making the exact same money, but your ability to profit from it has been cut in half. Also, even if your investment is going up, it's really hard to make a budget and live off of that investment. I mean, sure, it's gone up 12% yearly for the past 10 years. So how much can you spend next month? No idea. Maybe you start spending 12% per year, which is 1% per month. But what if for the next 5 years it goes up by 6% yearly? Now you have made a big mistake and have eaten into your original investment instead of the profit. It's really a huge roller coaster, especially if you want to achieve the dream of living from your investments. For that reason, I personally like using this strategy only for tactical goals, but not as my core general investment strategy. In my opinion, there is a far better one, and we will discuss it next. So click on the video on your screen and I'll see you there.